I'm Alicia Hyatt, editor of Mining Markets Magazine, and I'm here with Peter Besler, an investment advisor at MGI Securities. Welcome, Peter.
Thank you. It's an honor to be here, Alicia.
Today we're going to talk about M&A in the junior resource space, but first we're going to talk about how difficult it is for investors to get good advice when it comes to investing in junior resource stocks. You have a couple of ideas of why that is so difficult.
I think a lot of investment dealers discourage their advisors from advising customers to buy junior resource stocks, partially because they're a nightmare to supervise from a compliance point of view. There tends to be a lot of client complaints if things don't work out. And the second of all, that the trades in general tend to be smaller in nature, so they're less profitable for the dealer. So clients are not often exposed to these ideas by their advisor. Also, a number of advisors just don't have the time or energy to perform the required due diligence into these type of stocks. And so if you can find one that does, you should cherish that advisor.
So what is the investment rationale for retail investors to look at this space for investing?
Well, it's all about return. The potential on a junior resource stock, if it works out, is enormous, far greater than any other space that is in the market today.
We all know that valuations for junior miners are very depressed right now. So what's the rationale for looking at investing in potential takeover targets?
Well, I think takeovers tend to occur at two phases during the market cycle. One is at a top and one is at a bottom. And given the severe decline we've seen in the junior resource space, clearly we're not at a top. We're closer to a bottom. So when an investor buys into one of these stocks or a group of these stocks, they are buying at a bottom, and you still have the same type of upside potential, if not more, than had you bought at a top, but you're buying at far less risk. You're assuming far less risk.
Majors are being very careful with their money right now, and they're taking 10 or 20% stakes in juniors rather than buying them outright. What kind of juniors are likely to inspire a full-on takeover offer?
Certainly the seniors and the larger mining companies are in fact being very tight with their budgets and very careful, as you said. I think that the issue is that there is a shortage of projects of merit. These are companies that have high potential, low-cost discoveries in jurisdictions that are favorable to mining. So when one comes along, even if there is budget constraints in the big picture, it's still sure to attract a lot of attention from the majors.
How should investors start the process of selecting potential takeover targets?
Again, the key is to find a project of merit and then evaluate it using some simple techniques to determine how that company is valued relative to its stock price in the market, to look for differences, an undervaluation in the market, and using calculations to do that. So, for example, what's key is to look at the size of the deposit and apply some simple mathematics. Basically, I would recommend that as a rule of thumb, investors take 5% of the measured resources and add to that 2% of the indicated resources and add to that 0.5% of the inferred resources, and then multiply that by the recovery rate. So if a mining company can only recover 90% of the metal from the rock, then you take 90% of that calculation and multiply it by the spot price of gold, if it's a gold mining company, and you'll come up with a valuation. And then you simply look to see whether the market is pricing the stock above that or below that. The second thing is to look for companies that have low capital costs, because raising money today is very challenging. So an acquirer would have great difficulty swallowing a company that is going to require a lot of capital to go into production, but a much easier time raising money for companies that require low capital to go into production. It's less dilutive to their stock price. So companies that have low capital requirements will attract far more suitors than ones that do not.